As we've been chatting about, crude oil is trading modestly higher after its sharp decline yesterday. Now all eyes are on the upcoming OPEC Plus meeting taking place tomorrow. For more on what we can see, let's bring in Bill Baruch. He's the president of Blue Line Futures. Welcome, Bill.
Thanks for having me on today.
What are you expecting from the big meeting tomorrow?
I think you're starting to see the market price in the risk of adding more production than anticipated. They brought back all production that was taken off during the pandemic, those pandemic cuts through August. That was brought back. So the question is, are they going to continue to bring back production as they already are over compliant? I think the market's priced in a little bit of an ad, but as always, there's a risk of something that could be more excessive than consensus, and I think that's why you're seeing prices suppressed a bit here this week, on top of the global demand fears with recessions on the heels of that China's manufacturing data over the weekend.
Do you think that's a large part of what was behind yesterday's move in crude when it went quite a bit lower as well?
Yeah, I think there's a stew of news. The manufacturing data from China, Libya bringing back production fairly quickly, much more quickly than people would have imagined, and likely being able to get above this 1.2 million barrels per day. Overall, I mean, I think the reality is that the market's extremely tight. You've seen some of this backwardation come in a little bit down the crude curve, but really it remains very tight overall. And I think the SPR releases in recent weeks and recent months have likely worked a little bit to steady the curve. But again, the market remains very tight, and I think that I expect prices to overall hold ground out above $90. I'm using this dip, as a buying opportunity and positioning in the futures, but also looking at some of the equity names that have held very well and kind of holding upwards toward the near end of their range. You've heard some of these companies in their earnings calls. The CEOs are really emphasizing the supply being the issue and less worry on demand. And I think that's a bullish narrative going forward too. As we move into the winter, I think that's where the energy crisis in Europe really, looms overhead, and I think it's going to continue to keep a premium in the market and a bid on sell-offs.
So you do think this is a buying opportunity right now for oil?
Yeah, so we have a long core position that I've been working with, but adding into this dip here, and using some tight risk management in case we do get a surprise from OPEC Plus tomorrow. And that's really what this market's been, all year, and really since this run, from coming out of the pandemic is managing your risk, especially in the later innings here. The swings are more violent, and really the reason of those swings is you're seeing liquidation as the market starts to move lower sharply. Volatility, the ranges are larger, and some of the more professional traders, for institutions, they sort of just step aside. So you have to expect larger range, and that's really where you want to be managing risk. But I'm again using this as opportunity for now. I think if we can get out above, we're consolidating on a technical basis. 92.75 has been a big level for us. We really held it yesterday, held it again through this overnight in here today. It's building somewhat of a right shoulder and an inverse head and shoulders pattern. What we do need to do is still get, we're struggling to get above 95 and regain and hold above 95 in the near term. There's quite a bit of resistance in the mid 96s, but what I think is a technical headwind through last week has been the 21-day moving average, which if you go back to sort of the quarter 4 of last year, middle of last year, when this market really started to move, it got above the 21-day moving average and stayed above there. And when the sell-offs would be using the 21-day as a more of a buoying the market and sort of responding to that. But since the June rollover in crude oil, the 21-day moving average has been a headwind. So really need to get out above there, decisively close out above there. Friday it was, and then it failed. So I'm watching that to be a big indicator for a near-term momentum shift.
You mentioned Europe this winter. Are you also watching natural gas and feeling fairly bullish on that?
Yeah, we've been bullish in natural gas. I mean, you can't chase price rallies as you close in on the $10 area, but I think this recent move it was very quick. I mean, you got sell prices cut nearly in half, and then we rallied back to regain all those losses almost. If prices can settle back in a little bit, maybe not as low as $6, but if, as we move lower, I would anticipate seeing another opportunity to buy. Again, this is a market where risk management needs to be, really need to be in tune with that. And one of the ways we've been trading is using call spreads to take on long exposure and know our risk in the market.
Okay, and just quickly, gold is retesting the $1,800 an ounce level. How do you feel about that commodity?
One of the things that with gold is managed money went net short gold about 2 or 3 weeks ago, and when they go short gold, these are the hedge funds. Typically, it's a counter indicator, and it's a buying opportunity. And really, previously, 2015, when the Fed first hiked rates coming out of the great financial crisis, and that was December 2015, literally managed money went net short that week, and gold bottomed the day after Fed lifted rates off. The next time really in history that managed money went net short gold was 2018, and that was the later innings. Gold had already been selling off, and then managed money went net short gold. 2018 was the trade war, quantitative tightening, but them going net short in later innings was a buying opportunity. So I see gold's rallied almost $100 since the managed money went net short gold. It's another buying opportunity. So that buying opportunity has already played out. We have a lot of resistance up 1,800 to 1,810. I remain intermediate term upbeat, bullish, cautiously bullish on gold, but right now, not really holding a position, capitalizing at this 1,800 level. I'd love to see a pullback to being another buying opportunity. I think there's more upside ahead. Same thing with silver, a lot of resistance, 2030 to 2050. Managed money with net short silver as well. So I think it's if you were able to buy at some attractive levels, it's the time to monetize that, wait for the market to settle in if you're a trader and reposition. So I remain, again, upbeat. I think we're in a historically seasonally bullish time of year. It hasn't been so seasonally bullish in the previous, say, 5 years or so, but I think that could be a good tailwind because I expect the Federal Reserve to stop moving the goalposts. We're starting to see signs of that, and that was the response in the metals through last week. Now, the thing is, everybody's calling it a Fed pivot. I don't think they really pivoted. I think they're just less hawkish. So maybe some of the metals and have gotten a little bit out ahead of themselves. Another reason why I would be looking to manage risk on the metals here after this run is I'm looking at a historical bond chart. The bond futures, you can see the same thing inversely in the bond yields, but for the bond futures, there was a long-term trend line going back to 1990. And it broke that trend line this year. We very decisively, very quickly, as yields rose. It's coming back. The bond futures are now retesting that trend line as resistance. So, if the bonds roll back over, meaning yields rise, it's going to weigh on the metals.